Thanks, Seth. Thanks, everyone, for having me today. It's a pleasure to be back. Unfortunately, I was thinking, it's been about a year since I've been in front of, the CCIM group, and it's like I can just do an update, talk about how some of the risks have shifted in the outlook. But it turns out it's been 18 months since I've been here, and things have changed considerably. I remember back then the biggest question was, then candidate, then Secretary of State, or former Secretary of State Hillary Clinton, was she going to try and take away the 1031 exchanges or whatever? Like, that was kind of the biggest talking point we had in this room, maybe a little bit. What were some of the proposals? Obviously, the election did not go in that direction. We had a lot of different things happen from a policy perspective than maybe what we thought was the most likely. And so our office did a ton of work following the election in early 2017 as well when it comes to things that the Trump campaign had proposed, when it talks about trade wars and talk about immigration restrictions and talking about tax policy and things like that. And so we put together a lot of policy-related information, particularly in how it intersects with economic growth and the path moving forward. And then we basically sat on that for about a year, and nothing really happened in those first handful of months, maybe up to almost the first full year of the administration. But now all of that's back with a vengeance. We got major tax reform passed, and I know you guys last session had accountants and attorneys talk about some of the legal and technical aspects of that. I'm here to talk about a little bit how that intersects with economic growth moving forward. Immigration is still a hot topic, although not a lot of action on that. And then, of course, just within the last couple of weeks, the issue of trade restrictions, trade wars, tariffs, things like that have become, again, a hot-button topic, and I'll have a few comments to say about those. So, again, a lot has changed since we were last together in this room, and more importantly than that, more importantly than changes in federal or state policy, I want to say it seems like we're seeing a shifting of the winds in the economy. The story's changing. For much of the last 7 or 8 years, for that matter, it's been all about digging out from the Great Recession, putting all those unemployed people back to work, getting sales up, getting margins up, getting all these sort of positive economic developments straightened out and getting back to something approaching normal. And we're there, right? In the last 18 months in particular, we're starting to maybe even go beyond full employment by some people's estimations. I don't think we're quite there. I think there's still some slack in the economy, still some slack in the labor market, but significantly less than there was a year or 2 or 5 ago. And so what does that mean? It means we're entering into a new phase of the business cycle. The issues and challenges the economy faces is no longer about putting unemployed people back to work. It's about trying to find more workers to fill the jobs as businesses are continuing to expand. And some other headwinds and supply side constraints that we're starting to run into. And so, again, the story's shifting. Even the Federal Reserve has shifted their talking points quite a bit within the last couple of months as the data flows continuing to show healthy gains, and we've had significant changes to federal fiscal policy with the stimulus from the spending budget negotiations and from the tax cuts. So again, there's been a lot that's happened since we were last together in this room. First thing, though, to point out is that growth is still happening, right? The economy's still doing well, but we're clearly past its peak in terms of growth rates. This is just how many jobs have we added in Oregon or the U.S. over the last 12 months. How many do we have today relative to a year ago on a percentage basis? Dark blue line is Oregon, light blue line is the U.S., the typical state, the average state, however you want to talk about that. And you see here is a couple different things stand out. Oregon is more boom-bust than the U.S. That's for 2 main reasons. It's our industrial structure. We're still a goods-producing state relative to the rest of the country for the most part. Now, that said, our manufacturing is a smaller share of today's economy than it was a generation or 2 ago, just like it is everywhere. However, those relative declines and those relative shifts away from manufacturing into services are a little less pronounced here. Our manufacturing industry has done better. Our goods producing industries have done better than in the typical state, partly due to the nature of the manufacturing we have here. We're more aerospace, more semiconductor, a little more metals and machinery focused than say in the Midwest where they have auto parts. Automobiles and auto part dealers and manufacturers, those have declined substantially. We didn't have the textile mills that the South lost. And so that's some of the reasons Oregon has outperformed from a goods producing sector. The other thing that's more boom bust is population growth. People hunker down during a recession and they don't move. They don't want to move somewhere else where they can't get a job when they already live in this current place and they don't have a job there either. But during good times, people follow jobs. It's always a chicken and an egg issue, right? What comes first? Do jobs attract people, or do where people live attract jobs and business locations? And it's an intertwined discussion, but if you do some modeling on it, it's very clear that people follow jobs. People will move to where the jobs are located. So here comes job growth coming out of the recession. Here come the migration flows into Oregon like they always have, right? This has been going on not just since Lewis and Clark. You know, people haven't been packing up and moving to this part of the world ever since Pangea started breaking up and the continents were starting to be formed and we had the land bridge across the Bering Sea. You know, people have been moving to Oregon and the Northwest since then, and that's continuing to happen. Again, we're seeing strong migration trends, and we expect those to remain relatively robust moving forward, at least until the next recession. Then migration trends will plummet, and then we'll start the cycle again. So growth is slowing. You can see here, both the U.S. and in Oregon, job growth has started to taper off a little bit. That's because, we're no longer concerned about putting unemployed people back to work. They're already back to work. And so now it's about what is a more sustainable rate of growth moving forward. We're transitioning down to something like what is growth in the working age population, or at least that's how our models are looking at it. We're not there yet. We're kind of halfway between digging out from the recession and something more sustainable. So again, we're tapering down, but for good reasons, not for bad reasons as of today. And more importantly than this, we're seeing this economic growth translate into the feel-good nature of the business cycle. Poverty rates are falling, caseloads for needs-based programs are falling, food stamps are down, Medicaid, you know, the share of the population with that's starting to taper off outside of the expansion, and the ACA expansion, I should say, and we're starting to see household income gains really pick up here in Oregon. Our median household income in Oregon is now equal to the U.S., which hasn't been the case historically. You typically have lower incomes in Oregon than the rest of the country. Well, we're starting to catch up in terms of wages and in terms of household incomes today because our growth has been stronger. Here you can see Portland is now, 20, 30% above household incomes in the typical large metropolitan area around the country. We've had better growth here, and in fact, you could go so far as to say the gains we've seen locally in the last decade are transformational. Portland, if you look at the 100 largest metropolitan areas in the nation, your Pittsburghs and your Clevelands and your New Yorks and Los Angeleses and your Colorado Springs and Denvers and the 100 biggest ones in the nation, Portland really stands out. When it comes to high-wage job growth, which are things that basically require a college degree. They pay $60,000, $70,000, $80,000 and above for the median worker, the typical worker. We're top 5 in that type of job growth in the last decade. We're top 5 in educational attainment increases for the working age population, and we're top 5 for household income gains after adjusting for inflation, right? So the growth we've seen in Oregon has been great. The growth we've seen in Portland has truly been something you don't really see very often. It's been transformational. It's among the best in the nation. You can see other cities that have seen really good growth too. You see Seattle, Denver, Austin, San Francisco, the Bay Area, and a couple that you maybe don't think quite as much about. Raleigh, the Research Triangle there in Carolina, Nashville and Pittsburgh have seen really good growth, but Nashville and Pittsburgh were starting from a lower base. They were further down in the rankings, but they've seen a really good decade of gains, and this is something that's certainly impacting the local economy, local population, local businesses, and all that sort of good stuff. So this is all the stuff that we've seen happen in the last decade. Moving forward, as I said in the opening, we're starting to run into supply-side constraints. Some of the issues that are going to hold back economic growth, or they're barriers to push through, I should say. They're not necessarily going to hold back growth. They're only going to hold back growth if we're not able to move the ball forward and push these boundaries a little bit further. Economists, in esoteric terms, they talk about economies being at the production possibility frontier, right? Given the amount of people and given the amount of capital and equipment and resources you have in an economy, are we producing as much stuff as we can? And the answer is yes. And the answer is we're there again, finally, we think. And so to push that possibilities frontier further, you have to start pushing against some of these barriers and pushing out the economic growth prospects. Talking to other economists and people in this room, of course, you guys would know this too. On this list of possible supply-side constraints, one really stands out, and the one that really stands out is labor, right? Unemployment rate's really low. It's harder to fill vacancies for firms. They're having to dig deeper in the resume stack. They're having to get out bigger wage gains, all that sort of stuff that overall from an economic point of view is a good development, but it's harder for businesses to expand when you can't find the workers to do it. Everything else here is smaller than the labor constraint today. That doesn't mean it can't crop its head up, and it doesn't mean we're not going to have issues moving forward. In particular, the production capacity. I want to talk a second about that. If you look at the capacity utilization rate, how much of our warehouses and our industrial production and our plants and that sort of stuff are we actually using today? Well, we're now getting back to the point where our usage rate, our utilization rates are high enough that they require new investment. We're running out of spare capacity in our production facilities, and we're having to build new plants, new equipment, new warehouses, things like that to expand our businesses above and beyond that. We're finally back to that point, and we're starting to see this business investment pick up a little bit due to the point in the business cycle we're in. The one thing that I would maybe swap here, given the developments in the last couple of weeks, was credit availability, take it off of a near-term issue. I still think there's a little bit of risk there. It seems like a lot of businesses from a macro perspective have been ballooning the balance sheet in terms of taking on a lot of this low risk or this low interest rate debt, even though maybe they didn't need to. If you look at debt as a share of GDP for non-financial corporations, so non-banks, non-lenders in the U.S. economy, it's basically at an all-time high today. And it's a little interesting to see that corporate debt as a share of the economy is so high, given all the other conditions in the economy we've seen in recent years. So again, it probably points to ballooning the sheet a little bit, but that we'll have to see. So that's one risk for why credit availability could be a potential issue, particularly in an interest rate of a world of rising interest rates. So maybe credit availability is less of an issue today. Swap that over to something that put on the watch list and put trade relations in its place, given the tariffs that were just announced. Of course, they're not enacted. They've just been announced on Twitter. And so we'll have to see. It wasn't really meant to be a joke, but I guess it is. And so that is a bigger forefront issue today. So I'll talk a minute about labor. The labor market's tight, and it's expected to remain tight because there's two different cycles coming to a head right now. The first one's the business cycle, right? Again, unemployment's low, participation rate's up. Here we're looking at the share of the population that actually has a job. Instead of talking about the unemployment rate, we're talking about the employment rate. What share of the prime working age population in Oregon actually has a job? And we're back to where we were a decade ago. At the U.S., they're not quite back. They're maybe a percentage point lower than this. But again, the trends are in the right direction. But we still have a little bit room to run to get back to the economy we had in the 1990s. The question is, can we get there? The longer the expansion goes, the higher the probability we can erase some of this weakness, some of the stuff that maybe looked like permanent damage. If we can continue to run the economy strong for a few more years, I think that permanent damage will start to shrink, and we'll see some real gains. So where would these workers come from? There's kind of three pockets in the labor market that are underutilized today. There's people that claiming disability is a barrier to work, self-reported disabilities. We haven't really seen a corresponding increase in actual disability insurance payments from Social Security disability or private sector ones for that matter. Those are up overall because we have an aging population. So disability insurance payments are going up across the U.S. and here in Oregon, but as a share of the working age population, they're not really up. They're kind of a steady share. They're up a little bit, but not that much relative to the self-reported reason that people aren't working is the disability. So what does that mean? That is the biggest source of potential labor moving forward. It's also the biggest source of potential social ills. Why have we seen this big increase in those people saying they're too sick or they're disabled or they have some sort of barrier to work? Some people point at it and say that's the opioid crisis, right? That people are too addicted. They have mental health issues and they have drug issues that maybe they don't qualify for official disability programs, but they obviously can't hold down a job because of some of those other activities in their life that prevent them from showing up on time and performing tasks and all that sort of stuff. That's one reason. Some of it could also just be people trying to save face because it's a really hard thing to talk about when you say, I lost my job and nobody wants to hire me, right? Because my skill set doesn't match the modern economy. Something like that's a really hard thing to talk about, especially when a government worker comes knocking on your door asking me, like, hey, why don't you have a job? That's a tough thing to do. So we think there's some of that going on. And now that the economy's tight, we're going to finally be able to test this hypothesis to see, will the share of the population that cites disability or illness is the reason they can't work, will that start to come down? It looks like it's a structural problem, but can we see a cyclical decline in a structural problem is the biggest question, I think, facing the labor market. Other pockets of underutilized resources are stay-at-home moms. Stay-at-home moms with elementary school-aged children are participating in the workforce 10 to 15% less than they did 15 years ago. I don't think we're going to get the newborn moms back, particularly given child care costs. particularly for newborns. Here in Oregon, it's among the worst in the nation. But I think of the elementary school age population, their mothers are a source of potential labor moving forward. It's a little bit of a different population, and they have different work requirements and flexible hours and all that sort of stuff that goes along with child rearing, as most of you know. And then the third one would be young workers, right? We've seen a big surge in college enrollments. Those are starting to unwind, and so we're going to have higher labor force participation rate, higher employment among teenagers and classic college age years kids moving forward. So that's kind of where we think some of the labor is going to come from. The other reason, so that's the cyclical reason, right? The labor market's tight for cyclical reasons because the economy is strong. It's also tight for demographic reasons because we're seeing a big surge in retirements among the baby boomers as they're exiting the workforce, right? And this is going to continue for another 15 years until the baby boomers are kind of right now straddling their active retirement years and their later career years. Well, in 15 years, they're all going to kind of be into their active retirement years. And so this is putting a demographic constraint on the labor force, on the economy, and again, these aren't just any old workers that you're losing. These are people that have a lifetime of experience within your industry and within your firm, and so it's a really hard thing to replace them. That said, it's opening up opportunities for the younger generations to advance their careers and step into some new career tracks that maybe they didn't have before when the pipeline was more full than it is today. So again, this is why labor market's tight, why it's going to continue to be tight moving forward. So we put all this together. What do we think in terms of the outlook, right? And so the biggest thing when it comes to the leading indicators, so economists have trouble with turning points in the business cycle, as you probably know. And our models don't deal with turning points that well. And so one of the things you can do is look at leading economic indicators, things that generally turn down before the business cycle turns down. And any one leading indicator can give you false signals, right? It predicts, the stock market's predicted 9 out of the last 5 recessions, that sort of thing. A lot of the indicators look like that. And so you take a bunch of them and you put them into a pot and you stir it together and you try and read the tea leaves. You're like, what is this cornucopia of indicators telling us? Are they all kind of going up? Are they all kind of going down? That sort of thing. It's a red light, green light thing. It doesn't necessarily forecast magnitude of growth moving forward, but again, is it up or is it going to be down? And right now, all the leading indicators are still green. There's a couple that are yellow, that are slowing a little bit, but there's nothing that's flashing red. There's nothing in the economic data flow that suggests a recession is on the horizon. And so this means economists are pretty sanguine about the probability of recession. They're pretty bullish on near-term growth because the data flow is so healthy. And even if these things started turning down tomorrow, for whatever reason, they all started turning down, that means we still got 6, 9, 12 months before a recession ensues. So the 2018, the probability of recession is down to 13% if you look at the Wall Street Journal consensus forecasters. This is subjective probability. Our office is more like 20%. But again, it's a really low probability of recession because the data flow is so healthy. And on top of that, we're starting to run this experiment where we have a strong economy, a tight labor market, the data flow's healthy, and we're now going to run a fiscal experiment where we're stimulating a strong economy. We've never really done this before. At least we haven't done it in a couple generations. A lot of people point to the 1960s as a good example for when we had a strong economy, low unemployment, and then we threw in fiscal stimulus, and we had wars and things like that. And so we're stimulating the economy today from this relatively strong vantage point. If you look at the magnitude of the cuts from tax reductions and the spending increase, we're talking, 1 to 1.5 percentage points of GDP stimulus in 2018 and in 2019. That said, no forecaster is saying GDP is going to be 1.5% higher than it would have been. They're paring back the real impact on the economy for 4 reasons. The first one is the point in the business cycle. Again, it doesn't matter which type of economist you're talking to, where you get your, they're all going to point to the strong economy today as one reason for getting less bang for your buck than you would have if you impart these types of stimulus packages during a recession where we know for sure we have underutilized resources and we can put people back to work. So the point in the business cycle is one reason. Another one's the nature of the business cuts, or the tax cuts overall. We did a permanent reduction in corporations, put more money in their pockets, hoping to spur business investment. This is unlikely to spur a ton of investment in and of itself. The reason is not that businesses shouldn't be investing more. I think the economy could use a whole lot more business investment, but the cost of borrowing capital, the capital costs of borrowing money, I should say, have been declining for decades now, right? It's not high interest rates holding back business investment and taking on loans. Their profits have been rising for the last 15 years, 20 years in particular, corporate profits as a share of GDP have been relatively high, if not at an all-time high in much of the last few years. So it's not necessarily access to capital that is holding back business investment. So we're not shoveling, but we're increasing the money on their balance sheets. Will that spur the additional investment that the economy needs to moving forward? Let's hope it does. And I think a lot of people say that will maybe raise potential GDP 0.1 percentage points, right, over the long term. That's a positive. We'll take every percentage point of GDP we can get, but we're not going to see a huge gain in potential economic growth from that tax reform alone. So that's part of the nature of the cuts. And the other part would be that we have temporary high-income household tax cuts, right? It's geared towards higher-income households, which save a chunk of it. They don't spend 100% of it, so that will reduce the true economic impact in the short term. But more importantly, it's temporary, right? A lot of these things phase out starting in 2025 and things like that. And so even if we get short-term boosts in the next couple of years, it's going to turn into a long-term drag. Of course, Congress can act to extend a lot of these things, and they probably will to some extent. Even the Bush tax cuts got extended for everybody except for the very highest income filers. So again, the temporary nature is working to drag on the true economic impact, particularly over the longer run. And then the fourth reason, I should say, has to do with the Federal Reserve. How are they going to react to a stronger economy, higher inflation? We're boosting economic growth above potential. This will boost it above potential for at least a year or two. They're probably going to raise rates faster, which will then also curtail the true economic numbers. So that's some of the reasons why we think the impact of the spending deal at the federal level and the enactment of these tax cuts won't provide a dollar-for-dollar boost to the economy. That said, it's all the studies you can see up here is kind of a literature review. They're all positive. All those numbers are positive. They're just a small positive. It's on the margin. So it's an improvement to growth, just not a game changer as of today, the way that economists are modeling these things and talking about them. And it's also impacting the state budget. I won't bore you with all the details here, but we had some really unique quirks in Oregon law about how our corporate tax is tied to a specific provision in the IRS code that actually meant the deemed repatriation dollars flowing back into U.S. corporations work to reduce Oregon's corporate revenues, not increase it as a one-time windfall as you would have in most states. Legislation fixed that. Same thing on the personal side. Only 6 states tie to something called federal taxable income instead of adjusted gross income. The 35 states that tie to AGI, this discussion that we just had where the legislature passed a bill to remove the tax cut for small businesses or for S corporations and pass-through entities and things like that, that was not an issue in 35 states. It was only an issue in 6 states because we tied to a specific provision where that pass-through deduction at the federal level also resulted in a pass-through deduction at the state level, reducing Oregon state tax revenues. Again, it wasn't an issue in most states, but it was here, and so we had a big fight about it. The legislation came out that we're going to not allow that at the state level. We're going to decouple from it. And so a lot of this this red bar where the tax cuts reducing state revenues, that's now gone away due to legislation that's been passed in the last month. It's going to start to increase state tax revenue in the near term, and it's going to increase state tax revenue in the long term because of the repatriation, the other components of the corporate reform with the GILTI and things like that, where you're bringing foreign income back into the U.S. We're going to get a chunk of that here in Oregon from our corporate taxes and things like that. So again, that's some of the detail we've been dealing with in Salem, particularly since the passage of the bill in December when President Trump signed it. Within the tax cuts, within the legislation, the tax reform legislation, there's a couple of different things that impact the housing market specifically. From an investor point of view, they're usually positive, right, in terms of being able to still deduct your state and local taxes and getting the deduction on the pass-throughs and things like that. From an ownership perspective, from a household perspective, a lot of the changes in the tax bill work against home ownership and swing that pendulum a little bit back in favor of rentership. It's on the margin, right? We've reduced the amount of qualifying mortgages because we can only go up to $750,000. We got rid of the deduction for state and local income taxes and property taxes. We eliminated the moving expense. Again, I don't think any of these in particular are a massive change to the homeownership calculation. It maybe is if you're looking to buy, specifically $1 million or $1.2 million home. It's a bigger deal, but from the overall housing market, that's not that big of a deal. But again, it's on the margin. It's working against homeownership for the typical household. And then the estate tax doubling has implications for federal revenues and has implications for moving. And the other thing that didn't make the final bill that would have really impacted the housing market was the capital gains exclusion, right? Where it's now, what, 2 out of 5 years you have to live in the home to get that. The proposal was originally shifting that to 5 out of 8 years, right? That would have been a big change. And the problem today at the housing market is we don't have enough inventory on the market. So if you make all these things work to people moving less and to staying in their homes longer, then that would have exacerbated the inventory issues we're seeing in the housing market. Same thing with the estate tax. Right now, people don't have to move. They can stay in it longer, get that better appreciation, and not have to worry about federal taxes to the same degree. So again, none of these changes help the housing market, and I think they actually work against it from a general perspective. In a state like Oregon, where we have a housing crunch, it's not necessarily welcome from that specific situation. And so something that will impact you from an investor perspective are rising interest rates and how they're influenced on cap rates and things like that. It also impacts households and borrowing costs for all sorts of businesses. We're now clearly in a world of rising rates, and the question is how fast? And the answer is we don't know, right? What you see in front of you is stuff we put together a couple months ago, just been updating it a little bit based on some of the weekly interest rate movements we've seen. The old baseline was that the Federal Reserve would hike interest rates 3 times in 2018 and 3 times in 2019, right? So 25 basis points each time. So 0.75 percentage points each year, 75 basis points each year. I think that calculus has shifted. Given the stronger GDP numbers and the stronger inflation numbers we're seeing here in the U.S., the global economy is starting to rebound. A lot of the headwinds have shifted to tailwinds as Fed Governor Brainerd, as she said in her speech yesterday, and she was one of the most dovish members of the Fed. She talked about, the dollar's no longer appreciating, the dollar's depreciating against a lot of our major trading partners, and so that'll help boost our manufacturing exports. And a lot of these things are starting to help the economy, and if she's on board with going from 2 or 3 interest rate hikes up to 3 or 4, you can darn well bet that the consensus of the rest of the voting members is also moving their dot plots up higher and looking to raise interest rates. In fact, the new chairman, Jay Powell, he said in his congressional testimony the other week that the Fed is now worried about avoiding overheating of the economy. That's language we haven't seen in quite some time, right? Here it's clear that the Federal Reserve story is shifting. We've entered into a new phase of the business cycle. Supply constraints are a bigger deal, and the Fed is on board with this, and they're going to raise rates at a higher or a faster pace. What does that mean exactly? We don't know. Other federal speeches in recent weeks have said, well, there's still going to be gradual increases, but what does gradual mean? We don't know, right? And so the question is how fast will they go? They're still saying they're data dependent, but I think the baseline forecast is gone from 3 a year in 2018 and 19 to 4 a year in 18 and 19. We'll see. We'll see officially in 2 weeks. The Fed's meeting, and they'll release a new economic forecast and projections and all that sort of stuff here in a couple weeks. So we'll know for sure at that point in time what their initial movement is. But that's what most people are guessing. What is the impact on long rates? That's also a $1 million question, right? Are the long-term rates moving up in recent weeks just because we know the Federal Reserve will tighten more? And if that's all it is, then it's a little iffy in terms of the long-term prospects. If the long-term rates are rising faster because we think economic growth potential has been raised significantly, or we have inflation expectations that are rising above where they've been anchored to at this 1.7, 1.8% trend for quite some time, then maybe the long-term potential of the economy and the long-term terminal funds rate for where interest rates will land in this business cycle is higher than we thought it would be previously. Right now, we're saying 2.5% to 3% Fed funds rate for the terminal landing spot for the economy for this business cycle. Given productivity is down around 1%, we have labor force growth of 0.5%. So that means the potential of the economy is in the 1.5% to 2% range. That means your Fed funds rate's in the 2.5% to 3% range. And so the biggest question here from an economic perspective is, have we transitioned out of this low growth economic environment into a more higher growth environment? And if so, then these rise in long-term rates are actually really good news from a long-term economic perspective. And that's an open question. I don't know if we have any answer to that, and I don't know when we'll find out the answer to that, but that's a lot of the thinking and discussion that's going on in terms of the economic outlook and also in terms of the Federal Reserve reacting to the economic outlook. And so the question is, interest rates are going to go up, long-term rates are going to go up, but they're probably not going to go up one for one with the short-term rates. You either expect them to slow down, you expect them to increase at a slower pace than just the short-term movements that we're seeing. Put this all together in terms of the economic outlook in Oregon, we're going to see job growth continue. We're going to see job growth continue above potential, above what is needed to keep up with the working age population growth, which is kind of that red bar there. It's a very similar type of story to what you hear at the federal level or the U.S. level, where GDP will be above potential in the near term. But then again, we're transitioning down to something more sustainable, more in line with population growth. But again, you can see a rebounding growth, and it should be continuing. We just got new numbers yesterday in Oregon. December and January look to be better than expected in terms of job growth, but these are unrevised, very preliminary, taken with a massive grain of salt. We'll wait a few months until we get a couple rounds of revisions in the data, and then we'll see how they're shaping up exactly. So that's the big picture outlook in terms of where we are. Some issues and risks that we're saying. As I was saying, I think this potential for a trade war or an escalation of something beyond rhetoric or beyond tweets is a really big risk to the near-term outlook, right? Again, we're humming along as an economy. We're going to stimulate it. We're going to boost investment. We're going to boost spending in the next couple of years. But now we're saying, yeah, but we're not going to bring any imports into it, right? We're going to restrict the supply of goods into the economy. That recipe is not a good one. And so here the point is, it's not specifically trade with China or trade with Mexico or trade with Canada or whatever the case may be. It's not these bilateral one-on-one movements that we're worried about. And it's not just a 10% tariff on aluminum or whatever the case may be. These very narrow, focused, individual things won't alter the economy very much if they stay at these very narrow, focused intervention levels. The biggest issue is that we live in a world of just-in-time global supply chains where everything's interconnected from a manufacturing and a goods producing and a service producing point of view. This is just a chart trying to show you that 20% of manufacturing in the U.S., 20% of all the inputs in the intermediate goods that we do in manufacturing in the U.S. Is imported, right? 1/5 of our production capacity, one-fifth of our inputs come from overseas. So to the extent that deteriorating trade relations muck up these global supply chains, that's going to be a big problem for the economy overall. And it's going to be hard to isolate the losers in this. The winners are very easy, right? Producers of steel and producers of aluminum, of which we used to have locally. We don't have any aluminum left, I don't believe, but we did a couple decades ago. They're going to be clear winners, but everybody else is a loser on a small scale. The losers are diffuse across everybody, and we muck up the global supply chains. Every firm is going to be impacted on this because some of their suppliers or some of their customers are going to be mucked up in the system too. So this is the concern. This is where we're going potentially if we continue down this road of deteriorating trade relations and tit for tat and an acceleration in this type of stuff. Again, it's not any one particular action. It's going to be the cumulative impact overall that's potentially a risk to the overall economic outlook. Another risk to the outlook, particularly for Oregon, is population growth. Again, it's a boost. It provides a young, ample supply of skilled households, skilled workers here in Oregon that we've benefited from as an economy for quite some time. In moving forward, we're expecting this to continue. We're expecting population growth to slow a little bit. It's going to slow in a more uniform pattern than what you see in front of you in the gray bars, where it just kind of drops down and flat lines. That's due to the nature of our local forecasts. They kind of do it on a 5-year basis, right? At the state level, we do it on a year-by-year basis, but at the local level, demographers forecast on a 5-year basis, so I'm just extrapolating between those 5 years. So it's going to be a smoother tapering of population growth than what you see there. But again, population growth is slowing. Population follows the jobs. So as the job growth has started to slow, we're going to see population growth start to slow. And leading indicators for population growth have already slowed a little bit. Not a ton, but they've taken a step down when it comes to the number of driver's licenses turned in at the DMV, right? When you move to another state, you get a new driver's license, you have to give up your old one to get your new one. And that's a good leading indicator for population growth. Those have taken a step down over the last 18 months. At the Oregon level, and population growth has started to slow a little bit. Here in the Portland region, it took just a hair down in 2017 relative to 2016, but not significantly so. We expect the next couple of years to come in a little weaker, but still a lot of people moving here, a lot of young people, a lot of people with college degrees, sort of stuff that's supplying those high-wage jobs and those educational attainment increases we talked about earlier. That's going to continue. This growth that Portland's seen will continue moving forward, and it's a good type of growth. The reason it's a risk is due to demography. Over the last 5 years, in particular, births have continued to come in lower than expectations. Demographers keep saying, well, the birth rate can't get any lower, and then the next year data comes out and the birth rate's even lower, right? At first it was a business cycle thing. People didn't want to have babies in the recession. Well, they don't want to have babies in expansion either. The birth rate is falling, and it's falling substantially below replacement rates. And the Western world does not have good examples of when birth rates fall below replacement, getting them back up to that. And so births have continued to come in lower. We've been revising down our expectations for the number of new kids every year, and deaths have been rising faster than expectations. So you put those together, and our natural increase, what's called the natural increase of the population, which is birth minus deaths, has been shrinking, and it's going to continue to shrink and actually invert in 2030. 2032, I believe, in Oregon, which it's happening everywhere across the country. This is going on everywhere. It's not an Oregon-specific problem, of course. It's just, in fact, ours is better than a lot of other places because that continued influx of young working-age population. But again, it's something that's going to impact it, and that means we're entirely dependent upon migration in another decade for all of our population growth. So to the extent that housing affordability or something like that chokes off that growth, right? It's too expensive to move here, so people stop moving to Oregon or moving to the Northwest or something like that. To the extent that that holds back population growth, that means our long-run potential of the regional economy is lower. Because again, potential is based on productivity and basically the working age population. And so that working age population is not increasing in line with expectations. Our potential GDP is lower, our potential growth, our potential income, our business sales, all that sort of stuff we care about will be lower. And so that's why affordability is a big challenge. Not only does it eat into our budgets and make us devote a larger share of our household incomes to rents or to mortgage payments at higher price points and that sort of stuff, is it has the potential to choke off growth via what some call the Santa Barbara model, where they just say, we're not building anymore, and so you're welcome to have at it as you can, and escalating costs, and they see no population growth. That is the long-term scary potential of where we are, given housing. And I don't want to be too off the cuff here, but just this morning, I don't know if you guys are familiar with the fight that's been going on in the Pearl District about that new condo tower going up right across the street from that other new condo tower that they're preventing the other one from going up. It looks like the city council just voted that down this morning, that they're not allowing the new condo tower across the street from the other new condo tower. And so that sort of thing, when it comes to the unwillingness to build in our community from a societal or political point of view, that we know what path that leads in terms of affordability, right? We just look to our southern neighbor to the south. What has housing costs in California done for the last 50 years? We know that path. We're on that path. We have the chance to get off of it if we're willing to build more construction and to allow for better affordability. The question is, will we? And I'm pretty pessimistic today given the events of the city council this morning. But again, that's their prerogative. That's what the will of the voters. I get a ton of this from the neighborhoods. I get angry emails from neighborhood associations when I talk about housing affordability. It's amazing. But again, if that's what we as a population decide we want to do, and we elect officials that will impart those policies of our preferences, then that's what we're doing as a community, and that's okay. It's just we can't not build housing and then complain about affordability out the other side of our mouth. But I have a feeling we will. So what does this mean? What is the outlook? I don't think it's all doom and gloom. I'm sorry if I'm saying that. We think there'll be a little bit better balance in the housing market over the next couple of years for a couple of reasons. One, we're continuing to build more housing. New construction is edging up. It just hasn't been enough. It just hasn't been enough to keep up with population growth. We have very low vacancy rates and very high appreciation rates here across the Northwest. Our apartment rents have started to drop. They've started to certainly plateau and drop because we've had that surge of apartment construction. It's amazing how putting a ton of new supply into a market can stop the price increases And if we did the same thing on the single family side, we'd see the same results, but I'm not sure we're going to get there. But again, new construction is perking up. Population growth is going to slow a little bit along with the economy, so that's going to bring a little better balance to the housing market, but not perfect balance. We'd have to see even better construction numbers or even worse population numbers to get that better balance, and I'm not sure we will. On the bright side, I've listed over here on the right a lot of the things that have been holding back new construction in recent years. These are starting to get a little bit better. I think the biggest one is financing conditions for single-family developers. The loan volume from our financial institutions to single-family developers, particularly for land acquisition and development loans, is 60 to 70% lower today than it was a decade ago, right? So we opened the credit spigots for multifamily, and we got a surge of apartments, and that's now bringing a better demand and supply balance to the rental market, but we haven't open the credit spigots for single-family developers. Why? That's a good question. A lot of the banks will say has to do with capital requirements put in place by Dodd-Frank, and there's some regulatory issues and things like that. I don't doubt our banks. I believe them when they say that. I don't know the inner workings of Dodd-Frank. So I think that's some issue, but also I think it's to a certain degree, it's the one bitten, twice shy, right? Where you're scared, you're really worried about going out over your skis on residential investment, particularly at the local level. We've lost a lot of regional lenders that provided, community banks that provided lending opportunities for small-scale development, particularly in our rural communities where we're not seeing any new construction. So I think there's a lot of things going on, and I think that's the biggest factor in terms of the lack of new supply. Other things are certainly impacting it. Our urban growth boundary restrains the supply of land, so therefore there's less land to build on. It also raises our long-term housing costs. That is an issue, but that's not an issue in Boise or Dallas or Austin or these other places that are also seeing a housing crunch just like we are. Theirs isn't just as severe as us. So I think maybe that difference between the severity in Austin and the severity in Boise versus Portland, maybe you can chalk that up to our urban growth boundaries. But again, they're not keeping up with new construction in these other areas that like to build new housing. So that's one issue that's going on, but I think there's better balance in the housing market, and more importantly is that household income growth, right? Housing affordability for the vast majority of people in Portland has stopped getting worse. Now, it's worse than it was 10 years ago and worse than 20 years ago, there's no question, but on a year-to-year basis, affordability has stopped getting worse and is starting to turn around because the household income numbers are coming back up. So we're improving affordability via the denominator, your household income, not the numerator, which is your housing cost, right? And so we're starting to see affordability get a little bit better, but not significantly so to date. Moving forward, we expect these general trends to continue. Lastly, I'll leave with this because this is a brand new data set that I created myself, so you guys are the first ones to look at it. The question is, how much impact does housing wealth or home equity have on the economy? And there's a lot of research that's out there that's, there's small numbers, right? Out of every dollar increase in asset wealth, a household will spend, it used to be, 4, 5, 6 cents on the dollar, and they'll turn around and spend it in consumption. After the crisis, that number's come down quite a bit. The research is showing 1 or 2 cents on the dollar of home equity households are willing to spend. But we've had a massive increase in housing wealth here in the Portland region in the last handful of years. I pieced together a couple different data sets, married local household conditions, debt conditions with some federal data to estimate what does home equity in Portland look like. It's been increasing 3 or 4 times as fast as economic growth in the last couple of years. The wealth creation in this cycle in our housing market has been significantly above what it was last cycle. It's also been on a narrower base. Homeownership's down. Now, while homeownership's rebounded in the last couple of years, the overall homeownership rate is down. We have a very big discrepancy when it comes to racial and ethnicities and the wealth distribution. Wealth is even more concentrated than income is. And so, again, the people that are benefiting from this are a much narrower base and also a much more homogenous base than it was last decade. But again, this growth here, this growth of $15 to $20 billion in home equity growth here in the Portland region in recent years, each and every year, that translates into, 0.2% of GDP growth, right? Something that's pretty big just to consuming. Even if you're saying 1.5 cents on the dollar of this home equity wealth that we're building is turning into consumption, that's like 12% of local retail sales, and that's like 0.2% of GDP growth. So it's a big driver of local growth that we're seeing if this research on wealth creation and household spending patterns is to be believed. And again, I think it's fair to say that, out of wealth, people are spending 1 or 2 cents on the dollar. That's a reasonable assumption. We're not saying it's huge, but the wealth creation has been huge, and so that's driving some of Love our local income trends. Moving forward, again, it's been a tailwind to date, but moving forward, home prices are slowing. We're going to get that better balance in the housing market. So our wealth creation should be slower in the next couple of years than it has been in the last couple of years for those overall housing market trends. Now, it'll still be a positive for growth, but that is tapering off along with home price appreciations and things like that. And then debt's also starting to rise just a little bit with higher interest rates, higher home prices. You know, the new people coming online with mortgages have to have a larger debt to go to service that, and so therefore that's part of the reason why this is starting to drag a little bit moving forward. That's everything I will finish with. Here's my contact information, our website. If you want to reach out in the future, give me a call, send me an email. I'm always happy to chat about anything we talked about today or other issues you may have. I appreciate your time. Thank you.
Does anybody have any questions for Josh? Craig?
Yeah, given what's going, the level of growth in out of our area, and I'm really thinking of Silicon Valley and I'm thinking of Seattle, do you think there will be some rub-off in our little pond?
If you didn't hear that on the other side, the question is, growth in Silicon Valley and Seattle, will there be rub-off on our little pond? I think we're seeing that to a certain degree. So I think when it comes to the Oregon tech growth, we've seen good growth. We've seen above U.S. average growth, but not significantly so. Nothing like what we're seeing in the real tech hubs, right? We're a tech hub due to our hardware manufacturing. Obviously, Tektronix before them and Intel today. We're on the hardware manufacturing side. We're not on the software side. Our software sector is relatively small. It's growing quickly, but it's still relatively small. So from a small base, we're seeing good gains. So I think we're getting some spillover growth from that. We're getting a lot of outposts, not headquarter operations, which is a concern. We're getting the outpost. Whereas on the manufacturing side, we have those headquarter operations. And of course, we don't have Intel's real headquarters, but we have their R&D hub. And so when they've cut the spokes, or they've restricted the spokes in Arizona, New Mexico, and Colorado over the last 15 years, they've really strengthened the core here. And we've benefited from having those headquarter operations or R&D hubs. And we haven't yet developed that on the software side. All the people I talk to are optimistic about our long-term growth for software. And the trends have been very good, but I'd like to see how we come out another cycle before I'm willing to say we really are a software hub. But yeah, the general trends still stand. Portland is still one of the least affordable metropolitan areas to live in the nation. It's just some of the other ones on the West Coast are a little bit worse than us. That said, I still think we are more affordable than Seattle. If you look at the sticker price of a monthly rent or the sticker price of a home, it is higher than it is in Portland, but their incomes are still that much higher. We're seeing really good growth in those income numbers. Well, Seattle's seen even better growth in those income numbers, right? So we haven't necessarily caught up to the Silicon Valleys or the Seattles, but we're pulling away from the rest of the nation, right? So we're still kind of caught in between, and we're in no man's land, right? People look around, well, who are our peers, right? Who is a peer comparison metro for Portland? It's a really difficult thing to look at, right? Because people might look a little bit like us from educational attainment, or they might look a little bit like us from demographics, or they might look a little bit like us from our industrial structure, but nobody has all three of those at the same time like we have. We, at our heart, with that manufacturing base, we're still a Rust Belt metro, but with West Coast demographics, or something like that, right? I don't know how to say it, but so we're in a unique situation. It's a good situation to be in, but Seattle, I think we're still less affordable on the income adjusted basis. They have a higher vacancy rate. So if you're looking to find an apartment tomorrow, you can find it faster in the Seattle region than here if you just look at vacancy rates. And they have a significantly smaller population that is cost burden. The share of their rental households in the Seattle region that are spending more than 30% of their income on rent is significantly less than it is here in Portland, right? By maybe 10 percentage points. It's a big number. And so when you put all those together, again, even though the sticker price is higher in some of these other locations, our affordability crisis is worse. And I don't think that's changed. Maybe it is moving forward, given the apartment construction we've seen, particularly in the last couple of years, and we still have another 20 or 30 units in the pipeline, that some of those can be stopped in a recession, but most of them can't. So those units are coming online over the next 5 years no matter what. Apologize to some of you in the audience that might work against your business. But again, that's going to help with affordability, but that's quite some time in the future. It's a hard one, right? There's no question that we have this you see a border effect in everything, whether it comes to liquor sales or tobacco sales or business location decisions when you have such divergent tax structures in place. Right next door in Portland being our major hub, right on the border straddling it. We lose people and we lose businesses to Washington every single day, right? The benefit that Oregon has had is that we gain even more people and more income and more businesses from every other single state except maybe Idaho around the country, right? So the inflows have been more than offsetting the outflows due to that. And so it's a hard thing to decipher and put a true number on, but from that big perspective, we know the inflows are offsetting that, but that there are certain cost advantages to being located on the other side of the river. I don't think that structure is ever really going to change. It would take a really big shift in the political winds to touch the third rail in either location. So we'll see. But again, I think the tax issue and the tax difference is a real issue, and some people take advantage of it, some people don't. And so on net, Oregon is still seeing above average growth, and we're doing well. But you bring up an issue that I think is a very legitimate one, and it impacts some business decisions, just not maybe all of them. I think with the SALT deduction elimination, the big movers there, if you look at all the states, New York and California, right? Those are, because they're so much larger and they have such high incomes, or they at least have really large segments of high income households, that is a really, really big issue. It's less of an issue in Oregon, given our overall income distribution. Not that we don't have people that are affected significantly by it, but as a share of the population, it's less. I think included in some of the legislation that was just passed, they have provided an opportunity here in Oregon to try and get around that too. They are created an education grant program. I forget what they called it. Excuse me for that. Where it's an auction. You can buy it, or you can give the money to the state to this education grant opportunity program in lieu of your state taxes, and they're going to allow you to classify that as a donation to a charity, right? So the charitable deduction loophole, they're putting that in there. The accountants and the tax attorneys we speak to in our offices say that's potentially viable. There's a professor from Yale who's adamant against it being a viable option, but they say it's potential, but they would never recommend it to their clients. But maybe some other clients potentially could take advantage of that. So the state, they did put that in place to allow for you to try that as a tax behavioral shift. But overall, I don't know. I think the biggest question, to the bigger, broader point, right, is will these reductions in the state and local tax deductions, the federal tax, right, you can't take them anymore above the certain threshold, will that crimp blue states' tax revenue system, make them change their system, better align the burdens with their households relative to other states, that sort of stuff, that it's still too soon to say, right? Will this be such a big problem or potential issue for households that you'll see blue states in particular alter their entire tax system to take advantage of it or to get around the issues that it causes? That will be a long-term outcome, and I think it's an open question, but as of today, the answer is probably not over the next couple of years. Sure. Question about inclusionary zoning here in the city of Portland. I didn't highlight this at the opening slide, and I should have. I am here as an economic speaker. I'm not here on behalf of the state of Oregon, nor the governor, nor the legislators. These opinions are my own. I think it's very clear that the inclusionary zoning policy over the long term we're increasing the cost of providing housing. It will reduce supply. It produces relatively few units relative to the need, right? Again, and if you read the urban economic literature and the urban economists that are out there, we enacted a very stringent version of inclusionary zoning, right? There's less opportunities to put a fee into another fund, not to put inclusionary zoning in your building, but you can pay a fee into another fund, and they'll build some affordable housing units that way. Some of the stuff in New York only says you have to do inclusionary zoning if you ask for a land use change, right? So if you just build within the existing code, the inclusionary zoning doesn't apply to you. That's not the case here in Portland. It's basically everything. And so the pipeline has dried up of new applicants. There's a ton in the pipeline, but those were all already in the system or were hastily put into the system prior to the enactment of the policy locally. And since the official data went in, there's been hardly anything proposed. And the things we have seen proposed, if I talk to my friends at the city, are things that are trying to test the limits of the inclusionary zoning policy. And they're like, yeah, some developers are saying, yeah, I will put in these units that you're asking or you're requiring, but I'm not. How about we trade that in lieu of parking? Because parking is a very expensive thing to build, right? So we're going to put all these inclusionary zonings and maybe units and even maybe more than that, but I'm not going to do parking. They're trying to, push where those boundaries and limitations are on the policy, and it's still a feeling out process. So what is the long-term impact? It's unknown, but I think, again, with a stringent policy put in place, a relatively stringent policy put in place, I think the number of units it will create will be insufficient relative to the need.